Hey, welcome back to Two Super Guys Trade Stocks. I'm Dylan.
And I'm Vinny. And you're probably wondering, what are those two geniuses on the thumbnail and these two stupid idiots have in common? And that's that we all own Alibaba shares. And God damn, were we pumped about this most recent quarter. We're going to go through the earnings and talk about how sexy the numbers really were.
Two Super Guys Trade Stocks.
Remember, Munger and Burry, both Alibaba shareholders right now, along with us. So we're obviously in good company here, okay?
Clearly.
So earnings came out this week. Stock got a nice pop and then got crushed immediately on some other, China-esque news. I'm not going to talk about that particular thing. We could do a separate video on that if need be, but whatever. But basically, the real highlight here is, holy crap, this absolutely dead Chinese company grew 14% year over year on top line.
It was kind of wild because they've had no growth for a while. They've just been like,
Yeah. And then look at this other number. Is that a 3 and a 2? That 32%? Is that what that means? That is a sexy number, okay? 32%. EBITDA. I know, bullshit earnings, okay? Bullshit earnings. Yes, I completely understand. But still, even when bullshit grows 32%, you got to pay attention to that, right?
It's not completely bullshit earnings. It's not,
I forget who that quote's from. But this slide, the most impressive thing on here is just look at the number of green arrows. It's just peppered to green arrows. So that's how you know it's good stuff. Dylan's even hiding one behind his own head.
Oh, yep. Okay. Good call.
All right. Now, this is their highlights, right? And these are nice, sexy highlights here, man. The top line, 14%. They actually increment my operation up 30% year over year. Then the adjusted EBITDA we talked about already, 32%. And then income is same thing as far as EBITDA. Actual real GAAP earnings were up, and then non-GAAP earnings were up. The actual income per share, we're looking at big, sexy numbers here. 48%. 48%.
48%. Jesus Christ. I'm surprised it's supposed up more.
They achieve that and why it matters and why it doesn't matter, that sort of thing, a little bit here in a second. And then finally, in terms of where the rubber hits the road and the cash flow itself, you're looking at this right here, free cash flow, non-GAAP measurement, increase of 76%. 76%.
So, okay. So, yeah, I mean, you're the Baba earnings guy. Looking at just this and not seeing the stock price, because I was day trading that day, I would have assumed this went up like 10%. I think it went up like 6%, but I would assume like a gross amount.
It's the China discount, and it will forever be the China discount. The question of whether or not it ever comes close to parity with American investments, because if this were an American company, this company would have been up, what, 30% at minimum over that day?
Yeah.
If Google reported these numbers, I mean, holy crap, okay?
They'd be at 150.
Yeah, they would have blown the doors off. And it wasn't just like one thing that they did well. It was multiple things. This is when you're seeing a business that's kind of firing on all cylinders. And you know what? This earnings report made me think about something I'll talk about, I guess, a little bit later. But I also misunderstood Baba. Where Munger talked about how he thought it was a kind of technology company. In reality, it's just a retailer.
Yes.
I'm not even sure if it's a retailer as much as it is an incubator for other companies.
So this earnings report was arguably the most important in a couple of years, because this was the first time where they're reporting earnings after they split off into like 6 different companies. So now you're having a smaller look. I work for a corporate company. It sucks because you try to get something down. It's a nightmare. So when you're a smaller segment of something and now have sole leadership, you can make lateral or different moves much more efficiently.
Much more nimble. Yeah, I agree. They did say that part of their thought process for why this quarter was so good is that they're starting to see some increasing momentum in terms of this reorganization. They have reorganized the way they're reporting earnings a couple times, which makes following it a little bit more challenging. But I think they're just doing what they do, and they're doing it well. And they're having multiple businesses that are starting to turn the point where they're getting closer and closer to actually being, EBITDA positive, right? But on the bottom line, look at this. 6.5% increase in daily active users year over year.
That's
for something, all of Alibaba, you're talking about over 1 billion users.
Yeah.
Right? This is a big number, and it's continuing to grow. Something like you're seeing with like Meta is able to still do that somehow miraculously.
I should look at JD. I wonder how well JD did, because
I'm not sure if they reported yet, JD or PDD.
Yeah.
The other thing, we can certainly look at those individually as well. Their 88 VIP, which is like the Amazon Prime equivalent, they grew that double digits year over year. So that's telling you they're bringing more people that are closer relationship to that. they're having more contact with it, and they're bringing them in like tighter as far as into their ecosystem, which is
The
super important.
one of the, and I think you have it marked right here, one of the bear cases against it. I always try to read like why the opposite opinion, so I can see if I agree with him or not. And the opposite of opinion of why Baba sucks was this increase only came because it involved one of their big shopping days. Like we have Black Friday, and they
Yeah.
have, this is like their second biggest something.
The 618 shopping festival
Yeah.
right here is what you're talking about.
Yep.
Now, there's some interesting things going on with the Chinese and macroeconomic picture, and this was their attempt to address that directly. Now, there's some debate about the kind of different market segments between like JD and Pinduoduo. Pinduoduo has been growing very well, much smaller competitor, but that's because they're targeting more of value for money orientation, is what basically I'm reading. The 618 festival with Alibaba was designed to go after the same kind of consumer. As the Chinese economy has cooled a little bit, they become a little bit more price sensitive. That's where you're seeing more competition driving at this point in time, and that's kind of what the 618 festival is targeted towards.
Yeah. Okay. Got it.
And they were able to repurchase $3.1 billion in shares during the most recent quarter. They mentioned that in the conference call in a different way, and I want to put that out to you in a minute here, just because I think it's ridiculous the other way they kind of explain that. But 16.3 billion is still remaining authorized through 2025. I think we may see an increase in the share repurchase authorization sometime in the not too distant future. That's
Or
my
hopefully
suspicion.
they friggin' spend it. This is a low price for Baba. Just do it now.
Completely agree.
Especially when you
So
increase your cash flow that much.
yeah, you're looking at revenue here. Okay, this is all of the Alibaba business segments. Looking at total revenue, so 14% was the top line number, but one of the things I really want to highlight here is this customer management. That was 10%. Right? Do you remember me calling out this segment before?
Yeah, kind of.
Yeah, and the problem was it's the fattest margins, but it was consistently going down. They were still growing their direct sales in others category there, but they were losing the customer management. Customer management is basically the fees that they collect from businesses that are advertising on their platform. This is their advertising revenue almost, if you will. So this is like where you get a lot of the profit coming from, and the fact that they were finally able to grow this segment at a 10% year over year clip was pretty impressive because they haven't been able to do that in the past.
Right.
It's been a while since they've done it, at least.
Right. I'm hiding myself so you can see the numbers, just so you know.
Yeah, it's all good. So that's the major highlight I wanted to have here. The international commerce retail, look at that, 60% year over year growth. Still much smaller numbers compared to the actual kind of Chinese domestic products, but that's a hell of a growth pattern there. And then there are other segments here as far as the local consumer services, including their K-Now, and then cloud was a laggard here, only
Yeah.
4%. But
Jeez.
they explained that in conference call, and I think that's it seems like it's artificially being held down right now, which is I think
Okay.
interesting. If
Are you going to explain
they
that?
get a chance to unleash that, yeah, I
Okay.
will. So as far as the actual rubber hits the road here, as far as profits, right? When you're looking at the EBITDA, like I said, once again, bullshit margins, but look at the size of these numbers. They're increasing their EBITDA massively in terms
Yeah.
of their efficiency as a corporation. Meta talked about having the year of efficiency. Alibaba's mentioned that was a goal for theirs, but they haven't. They've delivered at a much greater level than Meta has.
Yeah.
Their concern or question is, are they doing this at the kind of cost of future growth, more R&D and things like that? You to watch.
These
But
are pretty disgusting percentages for a company that's as big as Baba and has 1 billion users or whatever they have.
yeah. And as far as the actual kind of delivering here of the EBITDA margin, this is what they're able to achieve, right? So they are able to grow this year over year. If you're looking at the actual change in their EBITDA, local consumer services right here, 2.8 billion RMB lost down to 1.982 billion for most recent quarter. So the businesses are really progressing. The K now there was a loss of 185 million RMB down to 877 million RMB positive now.
Positive.
That-
Okay.
yeah, that's what I'm saying. Is that you're having multiple business segments here that are now transitioning from a EBITDA loss to EBITDA positive.
This just,
Yeah.
it seems like the breaking up the companies was like a very, very solid idea. I know, I don't know this stuff as well as you do. You're definitely more the expert on this, but it just seems fishy that all of a sudden these percentages are absolutely ridiculous and fantastic. And in like the last 7 quarters, nothing has happened.
Yes, I mean, I think that you were watching a time in the Chinese economic cycle that was a little bit more challenging, and you're starting to see the kind of reopening post like pandemic for them. Whereas they had very strict draconian lockdowns
They
throughout
did. They
pandemic, and that was holding
definitely
them
did.
back in many ways. They've talked about how, unfortunately, some of their business segments have done very well in this segment post kind of pandemic. Other ones have taken a step back. If you actually look at their digital media and entertaining group here, that they're now actually EBITDA positive, whereas they were not before. It's a tiny, tiny little piece of the company, but that's because people are going to movie theaters. That they have a major portion of kind of movies coming out this year are doing very well, blockbuster hits for them. So they're having a great boon in that. Whereas like I think it was Sun Market or Sun something, that their actual grocery business that was taking Sun Art was taking a little step back this year.
Right.
They didn't actually put numbers in here for that I saw. I don't even know what segment it's rolled into now. That was an acquisition they made like 2 years ago, but that was doing very well during the pandemic, and now less so because people are doing less grocery delivery to home.
Got it. Okay.
All right.
Oh
So
boy.
this is one of the ways they've been able to achieve this ridiculous kind of expansion in terms of the EBITDA and cash flows and all those sort of profit measures, is that they've been controlling their expenses very well. See all these numbers right here are up in brackets, parentheses, right? Those because those are all negative. These are all portions that they cost control down year over year. Now, that's not always a great thing, right? Because look at one of the ones that has the greatest one, 3% right here. You're looking at the actual product development expenses. So that's the R&D budget, if you
Right.
will. And it's cautious to see that coming down. In the short term, certainly can give you a boon as far as like the actual watching the product, the financial metrics come forward. But are
It
you
can, yeah.
sacrificing future growth
Can
because of that?
definitely cripple you long term. Intel. There we go.
Intel is a great example of that. Yes, I will completely give you that. One of the other criticisms people have made is talking about the share repurchases and how they're barely outpacing their share issuance from a kind of employee comp perspective.
Yes.
This is a very unusual thing. This is actually the first time I've ever encountered this happening. Is that their share based expenses or compensation expense was actually negative this quarter.
How they took shares away from people? How does that?
Apparently, it's due to largely to the Ant Group subsidiary here because you look at the 6.8 billion negative
Yeah.
R&D. It's because of the mark-to-market adjustment in the value of Ant Group that this apparently happened. So that's why they saw this like kind of massive tailwind in terms of the profitability from this negative quarter of share issuance. I think the reason why I put this little red arrow here is to just highlight that they did still award shares on the Alibaba side, and it was about $600 million USD
What
just in
the?
that segment alone. So they are still continuing to issue kind of stock based compensation, which I don't have a problem with as long as they're doing it at a reasonable rate. Um, but this weird anomaly of this negative quarter in terms of the total stock based compensation, you can't count on that in the future.
So I've just someone's gonna ask this in the comments, and I'm not gonna be able to answer it. I still don't understand. I don't. Why is it? How do you have negative share compens? I don't get it. How did they do that?
So Ant Group, right? They were supposed to go public at massive IPO, and
Yeah.
they've been devalued multiple times since
Yeah.
then because they've been squashed by the Chinese regulator. I think the share-based compensation was issued at a much higher stock price, and now that the stock price has come down so much, they enable now able to take an adjustment
Oh. Okay.
because the stock
Okay.
price has come down so much. That's what I understand from this. This is the first time I've ever encountered this on any
I
company I followed.
I don't
So it's
think you'll ever see this again. I don't. Well, maybe 5 years. Maybe one more time.
yeah, probably not going to happen to Apple.
No, probably not.
Yeah, no. All right. So we're looking at the actual kind of balance sheet segments here, a little bit of stuff from this. I'm going to give you kind of a free cash flow yield here at the end, like I love doing. This is how much cash they currently have sitting on their balance sheet: 80.6 billion with a B.
It's so weird that they're not buying back more shares. I just don't understand.
I completely agree. I would like to see them increase the pace of these repurchases. Now, down here, they're talking about the cash provided by operating activity. So their cash balance is still going up. They had $5.4 billion in free cash flow this quarter, and they did 3.1 billion in repurchases. So their cash
Okay.
balance increased again.
Yeah, I mean that's fantastic. I don't understand why this is $100 a share.
Yeah. I mean, the crazy part is if you actually do the math out, each share of Alibaba US that you owns about $20 of cash.
That's so inappropriate. Okay. I mean, so there's a China discount and then there's this.
Yeah.
That's it's a China discount I don't think has ever been this discounted. I think there's so many weird geopolitical things happening that it's just like if China announces any good news, if China just comes out and says we're not going to invade Taiwan for 5 years, this is going $200 just like right away.
Yeah, I agree. There's so much uncertainty from a geopolitical standpoint that has nothing to do with the company itself, that it just keeps them forever to just suppress stock price. Now, the question will ever come back towards like an actual reasonable market value? That's tougher. But here's a highlight that I thought was interesting. Daniel Zhang, the CFO, called it out. But that 3.1 billion is like okay compared to the 5.4 billion dollars in free cash flow generated this quarter. That was still 1.4% of all outstanding shares they bought back this quarter.
That actually makes me more angry because that means they could have bought 5% of their company back in one quarter if
More
they
than that,
just
to be
did the
honest.
16 billion.
Yeah. So, but think about this from a standpoint. So I think right now I own about 140 shares. Basically, as a result of that, I bought 2 more shares of Alibaba this quarter without me having to do anything because the company
Yeah.
bought back much themselves.
I
It's kind
bought
of cool,
four
huh?
more. I'm at
Yeah,
200. Nice.
yeah,
All right.
yeah.
I'm
Kind of
waiting
sexy.
for it. I'm waiting for the
And this
slide.
is this is the cloud thing I want to talk about.
Oh,
So they talked about in the conference call the growth rate has also been partially impacted by revenue decline from a top customer. Now, I don't know if this is still the ByteDance TikTok thing. No one's ever confirmed that. I don't know if this is even the same customer, but maybe. But this part is a little bit more interesting. In the past quarter, we have received strong demand for model training, right, and related AI services on cloud infrastructure, which were only partially fulfilled due to near-term supply chain constraints globally. What does that say to you? Like, what does that mean?
it means that the growth is not it will most likely be more growth because the supply has outpaced what they can actually give out.
Yeah, the
So they
demand is
have more
outpaced the
supply
supply.
than what they can actually fulfill.
Demand. They have more demand than what they can actually
Sorry,
fulfill.
opposite
Yeah.
of what I just said. Yes, they have more
No,
demand than what they can fulfill.
exactly. So there is a greater demand for AI based cloud services, which they are positioned to offer, than they are able to fulfill at this point in time. So their 4% revenue growth was tamped down because they cannot keep up as far as actually supplying the infrastructure needed for this.
I mean, that's a good problem to have. So
It is. It is. I wish someone
there
had
we go.
asked. Yeah, I know. This is the sexy number. $244 billion
Jeez.
market cap as of close on Friday. $58 billion net cash. So they have the 80 billion. They have about $20 billion in debt. It gives you an enterprise value of 186 billion. They generated 5.4 billion in free cash flow this most recent quarter. All right. If you actually go back 12 months, it's actually a higher trailing 12-month free cash flow. But if I just annualized out this quarter, that was a $21.6 billion annualized run rate, which would give you about 11.6% free cash flow yield on that current enterprise value.
I believe Apple was 3.
Yeah. Apple's
Okay.
3. The U.S. tech giants are around like 4 to 5% for like Meta and Google. So this is less than half the price. You could get
This
like 4 Babas for one like Apple.
that brings into question exactly what I said about the Chinese discount. Usually it's been like a 20% discount. Now we're at 50 plus. This is
Yeah,
ridiculous.
yeah, it's more than half
Jeez.
off. That's how it goes, man. It's like the great China sale. So whatever. I'm perfectly happy after this quarter to keep holding this. I'm really optimistic about seeing what comes next for them, what they're going to be able to deliver this quarter, especially as like you talked about how the breakup and seeing whether or not this is a long term sustainable thing. Although the 6 units be able to be more efficient and delivering better cash flow for shareholders. It's a big question.
I would say they definitely can. It's in there's I don't see any downside to doing that. Corporate companies are incredibly slow unless you have like amazing managers, and just most people don't. So also their sectors are so different. Like it's just wild. It's not like Apple where you're always in it. They're just all over the place. So
Yeah, they're proven to be a great incubator for turning companies. They have many segments that are turning now EBITDA positive, cash flow positive,
all at
which
the
is
same time.
amazing to me.
Yeah.
Um, and don't forget, they have that committee that they commissioned on how best to return that $58 billion in net cash back to shareholders. So at some point, we'll see an announcement about what their plans are. They didn't talk about it in this quarterly earnings or phone call, but it'll be interesting to see what their plans are on getting that back to shareholders in the best way possible.
Yeah. Hopefully they just don't give it back to the CCP as, was it like a charitable donation or what? That'd be a bummer. So,
Yeah. Boo.
all right, guys.
Yeah. Catch the next one.